What's on tap for 2013 and where should you invest next year? Our roundtable includes Uri Landesman, president of Platinum Partners, a New York-based hedge fund, Patty Edwards, principal and chief investment officer for Trutina Financial, and Brian Sozzi, chief equity strategist for NBG Productions and editor of the Decoding Wall Street newsletter. Thanks to all of you for joining me.
Thanks for having us.
I want to start off with the economy. Uri, what's your outlook for the U.S. economy next year?
You know, I expect it to be a year of relatively low growth, probably somewhere in the 2% range. I think that we're going to particularly have trouble in the export-driven companies. I think that what's going on around the globe is actually trailing the U.S., so I don't think you're going to see a double-dip recession or a new recession, but continued low growth.
All right, Brian, as Uri mentioned, we're going to see another tough slog next year when it comes to the economy. We don't know whether we have a deal yet with the fiscal cliff. Global growth, of course, has slowed. Europe is in a recession. Uri doesn't think we're going to get a recession next year, but what's your take? Do you think the U.S. could slip into recession next year?
I actually dig that. I don't think we're going to get, what is recession? It's back-to-back quarters of negative growth. I don't see it. I'm looking for something maybe in the first half, maybe 0.5% to 1%, but because technically we'll avoid a recession, it might still feel like a recession. That's, you're looking at maybe 150K per month on jobs, not a lot of pricing power, not a lot of companies win. So it's going to feel like one, but I don't think you're going to see the negative growth rates because companies have come so far in the past 3 or 4 years.
The one thing that may have provided somewhat of a cushion to the economy has been the Fed's policy. Patty, how does the Fed's policy, QE3, QE and infinity, factor into your outlook for the economy next year?
Well, you can't fight the Fed, and so they are going to continue to be backstop underneath this market. But we're not calling for a lot of growth either. Just like the guys are saying, we really think that what we're in is a secular bear market, and so you're going to see a lot of choppiness, a lot of up and down, a lot of movement, but overall, not a lot of movement to the upside. It's going to be up and down. With the Fed, they're going to continue Operation Twist. They're going to continue to support the market. They're going to continue to try and get employment growth going. That's going to be a long, hard slog, though, and it's going to take a while for us to get.
Let's turn to Europe. The Eurozone economy has progressively weakened this year. Certainly the southern economies are in recession and looks like they're finally going to drag down Germany and France with them as far as growth is concerned. Yet we're seeing some signs that the crisis is easing. Yields on Italy and Spain's government bonds have come down. Uri, what's your outlook for Europe next year, both in terms of the economy and the debt crisis?
Yeah, it's very negative. I think what we keep on seeing in Europe is just a cycle where there are agreements and then they're sort of not kept to, and then there's negotiations and a crisis and more negotiations. I think the problem there is that the populace just doesn't get it, and they don't understand that the decades of entitlement that they've had are over, and that it's a real world we live in, and there are bills to pay, and the governments there are generally so weak that they're not willing to bite the bullet that they need to. And I continue to believe, I don't think we'll see the end of the euro or the EU in 2013, but I do think we'll see it, by 2017, let's say, and maybe a lot sooner, as, really the French and German populace, say, why are we supporting, the rest of the continent? And so I don't see that Europe's really taking care of their problems. I would look for, next to no growth from Europe in total, and I think it's going to continue to be a big drag on the global economy.
All right, you heard that, a call for the end of the euro perhaps in 2017, but not next year. Patty, what's your take specifically on Greece? It's really struggled to stay in the euro this year. The Troika seems to have finally agreed on measures that lessen Greece's debt load, give the country more time to pay back loans, but are those measures enough to keep Greece in the euro next year?
For the next year, probably. But really, what we're looking at is a longer-term time frame. And what we're looking at is a need for social and economic reform. And social and economic reform is something that's just not going to be easily done in that economy. So given that, I don't see that they are going to be able to get themselves out over the long run. This year, probably going to be fine. But the next couple, things are going to change, and I think they're going to change in a big way.
Brian, what's your take? What are the odds for a systemic shock from Europe next year?
Well, I think they've removed the systemic shock, whether it's the EFSF, the WWW, or the ZZZ, whatever plan they put in place. You're starting to see that, like the DAX up, the peripheral bond yields, they've improved. The market, I always look at it, price is truth. And the market is not telling you, or it's not suggesting that we are going to get the shock. But like everybody else has said, I don't think you're going to see a land of growth by the second half of 2013, because ironically, the improvements that you're seeing in the market are not transmitting to the real economy. Things are actually getting worse in areas such as in Italy, believe it or not, big source of risk.
Uri, a question to you. Do you think that Spain asks for a bailout next year?
I'd say it's about a 50% possibility. Things aren't really improving there dramatically. Patty just mentioned Italy. Spain and Italy are top 10 global economies. They are infinitely more important than, Ireland, Greece, anything like that. So that would be an enormous, reasonable shock to the system. There isn't one global bank that isn't heavily tied into Spain, and I don't think we're out of the Spanish woods yet. And I'd put it about 50% chance of a bailout request next year.
Turning to China, as the world's fastest growing major economy by far, China's ability to maintain strong growth is key to the global outlook. Uri, growth in China slowed this year. What's your sense of whether growth in China has bottomed?
I'm gonna step outside of the persona I've had so far in this interview and say that China is a place where I actually think is going to get better next year. So my sense is that things are improving there already, especially given how bad this year is going to come in. I don't know what odds I'd put on it, but I think that China may be one of the few places, significant places around the globe, where you're actually going to see better growth in 13 than you saw in 12.
Patty, do you agree with Uri's outlook for China? And what would that mean for multinational companies that derive a chunk of sales from China? Companies like Yum Brands and Tiffany's that have actually seen sales slow in China recently.
I do agree with his take. I do think that China is going to come around. And it's really a sociological phenomenon. You've got one man supporting not only his wife and child, but also both of their parents. They've got to have the growth. They need to get the economy going. They've got new leadership in China. All of this is going to feed into them doing anything and everything they can to keep that economy going. It'll probably be good for some of the lower end multinationals that would be in China. Specifically, we're playing that through Starbucks, and the growth in Starbucks should be phenomenal. Yum Brands, once again, that's really a play on KFC. I think they'll be fine. Tiffany, I think Tiffany's got some other issues going on, and so I wouldn't be buying Tiffany just for the China exposure. What I'd really be looking at, though, is the peripheral emerging markets that are actually tied into China and will benefit from their growth.
Uri, what will China's transition in leadership bring?
Well, I think it will, as was suggested previously, I think it's going to be very, very important for them to get off on the right foot. And the way I always analyze China is simply this: the only thing, in my opinion, that can create regime change there is if the people aren't being fed. And if people take to the streets, that's really the only thing that's going to bring down communism in China. Otherwise, I think everything's going to move along as it's done. They've sort of handled the transition brilliantly. You go to the large cities, you're like in any world capital, as long as people who live in Shanghai, Beijing, and 15 other places don't want to organize, government kind of lets them do what they want commercially. It's a little different, in the rural areas, but again, there isn't a spiritual fervor for democracy there, in my opinion. They want to feed their families. And so that's always job one of the government. It's job one of this government. I think that they will risk inflation in order to have very high employment and very good GDP growth. And that's why I think you'll see a number north of 7.5% next year, precisely because it's a new government. And if it was 8% or better, it wouldn't surprise me at all.
Turning back to the U.S. and the stock market, the bull market that began in 2009 is almost 4 years old. Brian, does it continue in 2013?
Well, here we go. I think if you're expecting what has happened over the past couple of years, it's wishful thinking. You're not going to see these type of gains in 2013 just because the profit cycle is markedly different. The past 3 to 4 years, you're getting accelerating earnings growth. Right now, you're getting earnings that are declining, and then we're going to have to start rounding out of a trough. Big difference. In this type of environment, not everybody wins. But you have to look at what's happening next year. Like everybody said, China will be an improvement. That'll benefit comparisons. Europe probably will not be as bad as it was this year. So are there reasons to be encouraged and believe that stock prices could go higher? And also keep in mind, companies used 2012 to massively restructure their businesses. That should help their earnings as well.
All right, so bottom line, you do think we're going higher next year, Brian?
I do. My S&P target for next year is 1505, nothing too crazy. I'm not looking for 20-25%, but there are gains to be made.
All right, Patty, what's your outlook for the market next year?
Well, we do think it's going to be a bit rocky. I'm not all of that optimistic about the whole fiscal cliff. I think that there's going to be a lot of turmoil. You see that in second terms, the first year of a second term, where you've got the new incumbent in there trying to make some changes. So politically, I expect that there's going to be some overhang. We expect that you're going to see maybe 6-7% growth here in the United States, but it's going to be very stock specific, as Brian was saying. And if you really want to see growth higher than that, you're going to have to look in other areas. So once again, I go back to looking at the emerging markets.
All right, Uri, are you bullish or bearish for the next year for U.S. markets?
Definitely more bearish than my colleagues here. I think you're going to see a range during the year of probably about 1275 to 1600, which is a very wide range. It's a little difficult right now to call year end. I'm kind of guessing that the year is going to end slightly below where we are now. So since it's not December 31st, I can't tell you if that's an up year or a down year, but I think the market is going to end 2013 somewhere in the 1400 to 1450 range. So depending on where we close this year, we'll give you that growth. But I think we trade higher during the year, but close somewhere in the middle of that 1300 to 1600 range that I think we'll see next year.
Brian brought up the issue of earnings and how we have seen somewhat of a change in the profit cycle. Patty, a survey done by the CEB, formerly Corporate Executive Board, found most executives think that sales growth has largely topped out. What's your view, and how does that bode for earnings next year?
So sales growth in the United States has topped out, we think. We do a lot of work with mid to small sized businesses, and given what they're seeing, if they are not able to grow their stuff organically, they are actually having to take market share. And a lot of what we're seeing is market share redistribution, not necessarily growth within those markets. The folks who are winning are the ones who are in technology, some of the minor industrials where they're able to do some exporting, and then beyond that, you're really struggling to find the growth.
Brian, you brought up earnings. You know, last we had you on the show, you were worried that earnings would continue to fall in the fourth quarter. Do you see earnings bottoming next year?
Well, that is a great memory, but yes, I do think I'm looking at the fourth quarter as being that earnings trough, and then you're coming out of that because what happens is this is the maximum pessimism quarter. New orders, there's no consistency in the reports you go. Pricing power is scant. You just don't know what's going to happen from day to day. So the first quarter of 2013, I think you'll see maybe more certainty around orders. People get a little more confidence around inventory planning, CapEx, and for those select companies, they might actually have some form of pricing power. You know, not explosive growth, but I think the fourth quarter of 2012 is that turning point or inflection point.
All right, let's move to sectors. The NASDAQ has been the real story of the year, up 13%. Uri, what's your outlook for technology in 2013?
It's actually reasonably bullish vis-a-vis the rest of the market. I could see technology actually outperforming. Brian mentioned before restructurings at companies. I think that was as prevalent at tech companies as anywhere. I think we've seen underspending at technology over the last 5 years throughout most of traditional corporate America, and I think you could see a combination of new product cycles and just some regression to the mean on percentage of revenue spent on IT as creating an environment where technology is one of the better performing sectors next year.
Patty, we can't talk about technology without talking about Apple, of course. It was certainly one of the hottest stocks of the year up till probably, a couple months ago. What's your outlook for Apple for the next 12 months? Would you be a buyer now?
Well, it's down, 165, 170 points from the top. I'm not writing tickets yet. I do think that it eventually it will be at a point where the stock is bottom, but I'm not good at catching falling knives. They really innovated well over the past year. The problem is they introduced too many new products. On top of that, you've got this whole tax thing that I think is feeding into the movement that we've seen on Apple in the past couple of months. What I'm really looking for is for the stock to bottom probably right around the end of the year, maybe the first week of January, and right around then I would be interested in picking some of it up. But I'm not going to be going hog wild on it. I think that it's an interesting stock, but you need to look at it on its own merits as opposed to the hype that's been surrounding it. It's cheap. I think it could get a little cheaper until then I'll just stay on the sidelines.
All right, another hot area of technology this year was social media companies. For better or for worse, I guess, depending on the name. LinkedIn was a strong performer on the year. Sentiment on Facebook also seems to have turned. Valuation looks a little bit better. Brian, would you be a buyer of either of those companies right now?
Well, if you held my feet to the fire, I would have to say Facebook. And now, nothing wrong. That's not an indictment against LinkedIn. The CEO is very passionate. We've sat down and talked to him. I think that they're monetizing the business very well. They have reinvented the resume and the entire employment social networking space. But with Facebook, I think sentiment, as you noted, is very low. A lot of people have gone underweight. I think the estimates might be too low. And the fact of the matter is, there's been more iPhones, more tablets shoved out the door. That's giving Facebook more areas of opportunity to monetize. And I think they're finally starting to get it on what they need to do in terms of monetization.
All right, switching gears a little bit. Uri, what's your outlook for the energy sector? We've seen oil prices really come down from their highs earlier this year. We also have this hydraulic fracturing technology, which is really unlocking natural gas and now oil. What's your sense?
Yeah, so I think what you're going to see is it's difficult to be wildly bullish about oil, given my view of the global economy, because obviously it is economically sensitive. So I don't know that we're going to see much movement in the price of oil. Natural gas, I kind of believe, for both fundamental and technical reasons, is probably going to have a rally. Most importantly, I think what you're going to see in the space is a lot of mergers and acquisitions activity. So, spearheaded mostly by the Chinese, who are very, very active in the Gulf of Mexico and in Canada, for instance, buying both oil and gas properties. And so, I believe that well-financed buyers are going to come in and snap up smaller companies, buying reserves that they need, reserves that they might be able to operate more profitably than the current operators do. And so stock picking is going to be very important in there, but I actually sort of feel like, natural gas is finally going to have its at least relative day in the sun vis-a-vis oil and vis-a-vis the other industrial commodities.
That's encouraging. Patty, the housing market looks to have finally turned the corner this year, finally. What's your outlook for housing next year, and how does that tie into your take on home builders as well as ancillary plays on housing?
Well, housing has bottomed. It is getting better. Everyone is all excited. I think the home builder stocks are up something like 68% this year. That's a phenomenal rally. But if you look at it, we are still below normal levels. What you're seeing is improvement, but we're not back to normal levels. I think you can continue to play on ancillary plays. I'm not interested in the home builders themselves. I just think that there's a little bit too much danger in that spot. What I've really been focusing on is things like apartment REITs, because we're not building enough homes, because the inventories aren't coming off the banks as fast as they were, and not everyone is going to be a home buyer going forward. I think you look at the apartment plays, and one of the ones that we're using is a company called Investors Real Estate Trust, symbol IRET. They are based primarily up in the Minnesota, North Dakota area, where the Bakken Shale is, once again tying into energy. They're building these apartment complexes and being able to rent them out before they even get them open, fully filled with the employees from the Bakken. I think that's a play that you can look at, and it's yielding 6%. Nothing bad there.
Thank you for that pick, Patty. Uri, financials had a strong year, outpacing the S&P. What's your outlook for the financial sector next year, especially as we're seeing sales sort of sag this year, and financial companies such as Citigroup that have had to go and laying off 11,000 workers to try to shore up their bottom line?
Yeah, I'm pretty negative on financials, which is somewhat of a secular bet for me. We don't really do any investing in financials. But my sense is that the financials still essentially aren't in business, and they're basically only willing to lend money to companies that don't actually need it. And it's hard to really grow very much when you're not willing to take any risk. Now, given their 2008 experience and the lack of credit research that they did leading up to that, I can understand their risk aversion. And obviously the regulators have made it a little more costly for them to take on risk. But until they get back in business, as it were, I don't really see that as a growth area. And given the strength of the stocks this year, I don't really think, I think they're more value traps than value plays. So continue to be pretty negative on most of the financial sector.
Brian, you spent a lot of your career following retail stocks. In fact, that's how you and I met, right? I had to follow you around on a mall crawl for Kiplinger magazine.
Old school.
That's right. So what's your outlook for retailers next year? Are there opportunities even if the economy remains weak?
Well, I think Patty was dead on earlier. First of all, Starbucks is the way to play right now. Pricing power, mobile makes sense. And also she's right on the money with Tiffany's. You ain't going near it. You don't want it. They have fundamental problems in their business. No pricing power. Negative. What I am looking for in 2013 is a big giant company that the market has seemed to forget about and that has some interesting or better comparisons compared to 2012. That's Nike. I think their balance sheet is very strong, generating a lot of cash. China will go from a major risk this year to an improvement next year for them. Europe is hit or miss, but I think a little bit better. But most importantly, their products are starting to finally go off or finally starting to have pricing power. And their costs are actually going down. So things are changing at Nike. The market doesn't necessarily care. I care. That's my pick.
All right, Patty, what about your outlook for multinationals? We hear invest in multinationals because they've got global revenue streams, but in certain cases, as we've discussed earlier in this roundtable, it seems to have been hurting some of those companies. What would you do for 2013?
Multinationals, I think you have to do it on a stock-by-stock basis once again. We had been very heavily in multinationals. We actually backed off of that exposure about 6 months ago. We're starting to look at a few select plays. But what you really want to be focusing on is exactly where they're getting their revenues from. So you want to look for someone who is getting their revenues more out of the emerging markets, more out of someplace like Vietnam or Poland, and less out of Europe. A lot of the international plays are really heavily concentrated not only in Europe, but in Russia, in India, in China. While China's coming back, I've got some issues with Brazil, some of those other BRICS. So, for example, you might want to look at something like a Philip Morris, 100% international, really playing into the emerging markets. I'd also look at something like a TAL International, which is symbol TAL. They are actually in the shipping business. If China does pick up, as we've been talking about, the shipping lines between not only China and the U.S., but also China and the rest of Southeast Asia will pick up, and they will do well also.
Brian, you mentioned you like Starbucks for next year and Nike. Any other favorite companies that you would recommend to investors for next year?
I've got two, a little outside of my zone. I'm going to go with FedEx and Boeing. FedEx, I think they've massively restructured their business this year, and the market is not necessarily accounted for in their valuation. Market has not cared. They've pushed through price increases. I think next year will be a better story for them. And also, in regards to Boeing, I'm looking for companies that are getting new orders right now and that can continue to get new orders in 2013. This company is getting massive new orders, and it also fits in with my thesis. They've restructured their business pretty significantly, and they're going to continue to benefit from restructuring probably until 2016. So they should win as well.
All right, we know that you don't like financials for next year. You do like energy. What other sectors do you favor for next year? Where are you finding opportunity for 2013?
I think there are going to be some things to do in healthcare. But again, that's sort of a very much a story-by-story name. There's some biotechs that we like. It's really tied into individual drug stories and M&A activity. Probably not too positive on commodities, given my view of Europe, low growth U.S. China will help a little bit. As Patty said, not so sure about the rest of the BRICS, but prefer emerging market exposure in general. That's really where we're focused: technology, energy, healthcare, and then we like the consumer space in China, not particularly in the U.S.
Thanks so much to all of you for joining us. Wishing you a happy holiday and a healthy new year.